The high yield sector has outperformed the broader market recently due to growing expectations of Federal Reserve rate cuts that will likely bring the federal funds rate down by a significant amount in the coming quarters and years. Additionally, the economy is increasingly becoming a concern for investors as there are growing signs of weakness. And this is causing many investors to shift capital out of the more speculative high growth names into more defensive names that tend to be more common in the BDC space, like utilities, infrastructure, triple net lease REITs, some conservatively positioned business development companies, etc. That being said, there are some high quality, high yield stocks that have lagged this market recovery. And so in today's video, I'm going to discuss two of these that I think are quite attractive opportunities to invest in right now. But before I get into today's video, if you could please subscribe to my channel, I'd really appreciate it. Help me to grow my audience and reach a broader audience with my content. If you could also like this video, I'd greatly appreciate it. Thank you very much. Okay, so the first company that I think is undervalued right now that has lagged the broader high yield space's recovery is Diversified. This is a diversified company. As it says, it's a private equity business, and they have two main segments. One is industrial businesses and one is consumer products. And these are niche consumer products that typically have a very identifiable moat, a strong position in their sector. They tend to be a little bit more defensive in nature as well because, again, they have a very targeted audience, usually the more affluent clients. And so those are people who are less impacted by economic downturns, because when you're wealthy, generally just because maybe your investments do worse or your business or whatever, but your job is generally much more secure, or your business that you have, you're going to have a lot more money, and your lifestyle does not change as much as, say, a person who's just living paycheck to paycheck when unemployment rises and the economy turns down. And so that's why they have this nice diversification, whereas their consumer defensive businesses is really what they are, tend to outperform during periods of economic weakness relative to the industrial businesses, which are a little bit more economically cyclical. And so they have this nice balance between the two. And we see this today in their businesses. Their industrial businesses have been struggling a little bit lately, struggling to grow, whereas their consumer businesses have been growing quite rapidly. And in fact, overall for the combined business, they were able to grow revenues by over 25% year over year this past quarter. They were able to grow EBITDA by 30-something% this past quarter. And so again, their adjusted earnings were able to grow as well at a similar rate. So again, their earnings power is still growing very rapidly, and they do this because they buy businesses that they believe have long growth runways, and again, those identifiable moats. They work with the companies to try to enhance the business plan and extract additional value. And then once they believe that they've optimized the risk-adjusted returns from their investment, they generally sell the business, take that capital and recycle it into a new opportunity. And so this is how they have been able to compound wealth for investors, earnings power for investors over the long term. And they also pay out a very attractive dividend. They pay out a $1 per share per year dividend that's currently around a 5% yield for the company. And so when you combine a double-digit annualized earnings growth rate over the long term, and that's what they're generating now and expected to generate moving forward, with that nice mid-single digit dividend yield, you get a very attractive total return proposition. And again, it's backed by a solid balance sheet and a well-diversified portfolio of businesses that are set up to do fairly well through all economic cycles. So it's a pretty nice setup if you want exposure to consumer and industrial goods from a pretty proven management team, but also get an attractive yield from it. And that's the pitch. That's why I own shares myself. And I feel like management has done a good job of serving shareholder interests in the company. So as you can see, it's a very attractive proposition. And on top of that, it only trades at 9 times adjusted earnings, which is very cheap for a company with a double-digit annualized earnings per share growth profile and a mid-single-digit dividend yield, especially with the quality portfolio that's backing it. And it's not particularly high risk, although I wouldn't call it a low-risk investment either. But on top of that, when you drill down underneath the surface and look at some of their individual businesses, they have some very exciting businesses. The most exciting one of all is Lugano, which is a luxury jeweler. They serve very wealthy clientele with very expensive and prestigious pieces of jewelry that they sell. So again, pretty defensive because those people are so wealthy that economic turmoil, stock market movements don't affect them too much. In fact, they look at Lugano jewelry pieces as one of the ways of diversifying their portfolio, just like they might buy expensive pieces of art or real estate or some other, wine or whatever it is. They view jewelry as part of that diversified portfolio. In fact, this is something they can even wear and enjoy. So it's another way of diversifying and preserving their wealth. Anyway, it's been growing very rapidly. It now represents about a third of their earnings. If you look at a trailing 12-month basis, they're also growing very rapidly. They grew by over 80% their EBITDA this past quarter on a year-over-year basis. And so it continues to grow and grow and grow, and they're opening new stores in Europe, etc. And so eventually management's probably going to have to come to a point where they're either going to have to sell the business altogether, liquidate a part of it, or something, maybe even spin it off, because again, it's becoming such a dominant part of the company that it kind of defeats their whole diversification purpose. And because it's growing so rapidly, they're having to invest a lot of their free cash flow from other businesses into it to fuel the additional growth with opening new stores, etc. And so if it wasn't for Lugano, this company would be throwing off a ton of free cash flow. So again, it's just an interesting situation, but it's a very exciting situation. It's a great problem to have. So it's worth watching, but it also bodes well for the company overall. They also have another company, BOA, which had been growing very rapidly. They had a lot of excitement about it, or they call it BOA. They had a lot of excitement about it, but then it hit a little bit of a stumbling block in recent quarters, but this past quarter got back on the growth track. And so that's another business to be excited. That should be growing quite rapidly for them moving forward. They have other businesses like Primaloft and Honeypot, which they recently acquired, both of those that have stumbled a little bit out of the gate, but they have very strong potential as well. Management's investing, getting those going. So again, there's a lot to like with Coty's growth potential. They're also thinking about entering a healthcare vertical. They're looking for certain deals, but they're being very patient with that as well, which I appreciate. Okay, the second high yield stock that I think is an attractive buy right now that's been lagging the broader sector is a business development company called Golub Capital BDC. Now, most blue chip BDCs right now, like Main Street, Eris Capital Corporation, Blackstone Secured Lending, they all trade at meaningful premiums to their net asset value, even if historically they haven't. Eris Capital Corporation, for example, historically has traded roughly in line with NAV, and it now currently trades at a premium to it. Blackstone Secured Lending, same thing. And so while you can argue for or against whether they deserve that premium, Golub Capital BDC, or ticker symbol GBDC, has a very impressive track record of sustaining and growing its dividend, of sustaining and growing its net asset value, of excellent underwriting performance, significantly outperforming the broader BDC space. It has 93% of its portfolio in senior secured either first lien loans of either one stop or two stop. Its dividend is double digit, and it's covered 123% by net investment income right now. Has a very reasonable 1.05 times leverage ratio, one of the strongest balance sheets in the sector with a investment grade credit rating. Has strong liquidity, low non-accruals of just 1%. And so there's a lot to like about this BDC. In fact, it recently reduced its expense fee to have one of the lowest fees in the entire BDC space among externally managed BDCs. So again, one of the best BDCs out there, and yet it trades at a discount to its net asset value. It's pretty remarkable stuff. I think it's largely due to a recently completed acquisition/merger that led to some lockup expirations for the acquired business and some excess liquidity in the market of the shares that have not gotten fully absorbed. So I think this is a temporary opportunity that I think investors can take advantage of. Again, I'm a little bit pessimistic about the BDC sector. You can see that in my previous videos. So I'm underweight the sector, but I think that GBDC is one that's worth considering for that limited exposure to the BDC space for the reasons I mentioned. And again, it helps balance your portfolio with giving you some of that floating rate exposure in the event that inflation does bounce back and the Fed has to pivot from cuts to hikes, or at least has to keep the rates at a higher level than expected for longer, and they're able to somehow navigate a soft landing or at least only a mild recession. I think a company like GBDC should perform quite well, especially compared to the broader market. So there you have it. You have a mid-single digit and around 5% yielding, rapidly growing business, private equity, as well as a BDC company, which is a lender to these middle market type businesses that Coty owns direct equity in. And they have a double-digit dividend yield, a much lower, low single digits per share growth rate outlook. Both have solid balance sheets. Both have strong management teams that are proven to seek shareholders' best interests over the long term. So hopefully this video was helpful to you. If it was, you could please, again, give it a like, subscribe to my channel to help me grow, and let me know in the comments below what you think of these two and if there are any other stocks that you would add to this list of high-yield stocks that haven't participated in the recent market rally that probably should have. Thank you very much. See you next time.